Hello, this is John with the Corruption of Money Part 2, and I'm making this program to address a lot of the confusion that's been circulated in the social media. I'm thinking particularly of Positive Money and Peter Joseph's Zeitgeist Addendum. Zeitgeist Addendum makes a complete muddle, I think, of central banking and fractional reserve banking. There's a lot of woo around fractional reserve banking, so let's deal with that right away. So fractional reserve banking and banking are absolutely synonymous. It's a bank's business to take a portion of the deposits given to it by depositors and put that to profitable economic use. And because banks do this by lending the money out to successful businesses and individuals, they're able to offer their banking service either for free or with interest to depositors. Now, the idea that when you deposit money in the bank, it then creates like 10 times more money in loans is a little bit misleading. You see, in fact, what happens is that money that you've got, that you deposit in the bank, had to come from somewhere. Either you were keeping it at home, or so that it was external to the banking system, or more likely somebody gave it to you for work you did, or a relative gave it to you as a gift or something. But ultimately that money would have come out from another bank. So of course what happens is, as one bank receives the money coming in, it can indeed increase the amount of money that it puts on loan to people, and thus you get this multiplier effect. But at the same time, the other bank where the money came from, their reserves have gone down, and so they have to reduce the amount of loans they make, or call in more loans, and therefore decrease their financial base. So this is actually a zero-sum game, fractional reserve banking, and the degree to which these banks can multiply their reserve is actually normally limited. If you just had a free market, it would be limited, because obviously if they overlent, then they would be at risk of not having enough cash on hand to pay to creditors to settle any debts that they've built up. And so there's kind of a natural control present in a free market on that ratio of what banks can loan out to people. Now, of course, all of the old money in the ancient world was commodity money. So it was wheat, it was gold, it was other things that were useful to people, and so the bank could only lend out at most 100% of its reserve. Now, with the advent of banknotes, it became possible to increase the liability of the bank by printing more notes, because banknotes are just promissory notes. And here's one I found on Wikipedia, which is I printed it out, and it's like a copy of one of the first banknotes issued in Europe by a central bank. And banknotes, of course, you can print off as many as you like, but again you have this problem of cash flow and having enough liquid assets in the bank to pay people who want to have their cash back. And of course there is a temptation for banks to oversupply banknotes and to run up liabilities, because of course in a commodity-based banking system, money is actually a liability to the bank. The more it issues, the more at risk its business is with respect to the depositors. And what used to happen in the world of private banking, obviously private banks would go bust if they didn't practice business soundly, but what they should have is an underwriter, or a number of business partners who underwrite the financial value of the bank. So they might be very big landowners, particularly wealthy individuals, and thus if the bank has a bit of a wobble and overlends and needs more money, it can either liquidate some of its assets like shares and bonds and so forth. And if it runs out of those in order to repay it on its liabilities, then it can call upon these business partners to maybe sell a bit of land or a building or something to raise the required cash to pay off to the creditors. So that's kind of how it did work in the free market for some time, until central banking regained popularity. Now, in central banking, the government controls the money supply, and it controls the interest rates, and it usually forms a monopoly and does not allow any unchartered or private individuals to produce banknotes. So this really is the beginning of the corruption of the money markets. And that banknote I showed you first of all has a very interesting story behind it, which you can find on Wikipedia if you look up the Stockholm's Banco, which actually went into liquidity. It was bankrupted fairly quickly, within about 10 years of starting business, because it had overproduced the banknotes and it didn't have any solid financial backing behind it. It was really just a fraud, and it was authorised by the government because there was a promise to give I think half the profits of the business to the state. So it really just was an icky government created mess from the beginning. So that's fractional reserve banking, and to a degree I've introduced the idea of central banking. Now, one of the other things which central banking brought with it eventually was the idea of fiat currencies. For a long time, banks had to back their promises with actual tangible assets, like gold coins. I mean, it's still true to a degree. For example, if you take a pound note into a British bank, you can exchange it for a piece of metal which has an actual physical value, which can of course fluctuate as well. And then there's the whole problem of carrying loads of coins around, and of course banks won't issue millions of pounds worth of coins for you to keep somewhere at home or even in the bank. They don't want all of that metal and the issues that go with it. So fiat currencies kind of did away completely with the commodity value of money with respect to the bank. So it's actually a completely bogus promise, and of course these could only be brought into existence through the coercive powers of the state, through the police force, the armies and so forth. What they did is they outlawed everyone else's ability to produce banknotes. They said you can't do that anymore. They said you must have and only accept the banknotes that the central bank produces. Now, of course, this is a creation of a state-run monopoly. It's essentially a form of nationalising currency, and it leads to immense problems because it prevents competition. So if the bank goes badly, you can't just let it fail and go. The state will want to prop it up with taxpayers' money, and it generates a desire by politicians to use the money creating potential of the central bank, because of course once a currency is detached from any physical commodity, you can produce as much as you like, and this can be used to further political goals like for example creating housing bubbles to stimulate economies, to paying for welfare, and of course the original reason that governments want to centralise banking was to raise money for war. So you can see this whole game is really very corrupt and is all about achieving political objectives, and really has very little to do with banking and finance ultimately, which are perfectly good and very valuable businesses. So that's fractional reserve and central banking. Now, of course, fiat currencies are empty promises, and, like I say, had to be enforced by law. So, what's the future? Is the free market still there? Is it possible? Well, this is where Bitcoin comes in. Bitcoin is a cryptographic currency. It has no physical commodity behind it. Now people have said it's the same as a fiat currency, which is absolutely insane because there's no government power here forcing people to have it. And the Bitcoin has an inherent and intrinsic value to it. It's actually bogus to suggest that things don't have intrinsic value. Value is whatever people assign to something. It's a completely subjective framework. So, for example, sand would be very valuable perhaps to somebody building a house in London, but to somebody in the middle of the Sahara Desert, sand would have no value. I mean, there's just plenty of it around. Now, Bitcoin derives its value from its ability to be electronically traded. There's no gold or silver to carry around, so it can be very secure, it can be very private. And the algorithm that generated the Bitcoins is limited, so that I think there'll only be 21 million Bitcoins in existence. They're also infinitely or virtually infinitely divisible, so they have all of the qualities of ideal qualities of money, and it can't be regulated by the state, and the state can't produce as much as it wants, and the state can't use it to fund war, and the state can't use Bitcoins to fund welfare programs, and so on and so forth. So it really is a rather awesome technology, and I think just a brilliant idea for replacing central banking. So what about nationalising the banking system? I don't think this is a solution at all. In fact, the financial system is pretty much completely a nationalised system already. It's just that private individuals and shareholders in the banking establishments are extracting wealth from what is essentially a government-granted monopoly. But putting this all into the hands of the state isn't a solution. You still have the problem that politicians are controlling the interest rates and money supply for political gain, and there's a moral hazard involved in that those that are engaging in a nationalised banking business can give money to pet projects that they like, who could just happen to be their friends and buddies on the side, who might give them kickbacks later. So you haven't removed corruption and private profiting from such a system. It's still a monopoly that will benefit those that are cosy with the state. And you still have the moral hazard of those that are engaged in the business aren't personally liable for it. The liability would still fall onto the taxpayers, and you still have a monopoly, a government monopoly, which punishes and eliminates competition and better and newer business practices. So nationalisation, not a good idea.